How is everyone doing?
Very well.
It's the middle of the day. The stock market is in complete chaos. It doesn't faze us. The fake rally from yesterday. And the market is down at just last check is down about 3.5%, 4%. Massive panic. Panic is in the stock market. Let's just see with a show of hands here, who here invests in the stock market? Who is currently invested in the stock market? Okay, yeah. Hey, Divya, so great to see you. Hey, G-Buck, so great to see you. Okay, yep. So we see a few hands here. Okay, great. Now, hi, Chris, so great to see you. All right, so here, let me just set the stage. Who am I? What are we going to do today? So my name is Andy Gupta. I know about half of you, the other half, welcome to my world. I'm a little nuts, a little crazy, a little Energizer Bunny, but that's okay. I wanted to take this opportunity. I teach a 10-week course. A few of you here are part of my course on how to invest. I'll go into why I do that. But I really wanted to have a workshop for all of you. And this is something that I literally taught my students last week. But given the panic that I'm seeing in the marketplace and how much fear and anxiety that must create amongst those of you who are invested. And I know that because I've been investing for 22 years. And I've been through, if this is a market crash, this is my 4th market crash. And I can feel what it feels like to have your wealth go down 40%. That happened in the 2000 dot-com bust. That happened in the 2008 financial crisis. And then in March 2020, even though I had 21 years of experience on Wall Street, when the market went down 25%, out of fear, I went 100% in cash. So if any of you are feeling, yeah, Giselle, if any of you are feeling that fear and anxiety, I feel you. But I didn't stay in cash. In 24 hours, I reinvested fully using some frameworks that I go through in my course. And the market, the portfolio almost doubled. And that's a different story. But the reason I want to come on here and do this free workshop is because I can feel the pain out there. I can feel the anxiety out there. And quite often when we operate out of fear and anxiety, we often make the wrong decision. So what I want to do in this 1 hour is accomplish one key objective. 2 key objectives. What is I want to connect the dots between what is happening, right? Inflation, which is at a 40-year high. Who is the Fed? What's going on? Why the fireworks every time this person called Chairman Powell speaks, which happened yesterday? And then what's that got to do with my stock portfolio? And why are tech stocks down so much more than a boring company stock like Coca-Cola? All right, so that's my objective. So after this workshop, I expect you'll be able to, at a dinner conversation, regale your guests about all of these topics and be able to connect the dots. But the idea is, once you understand this, once you understand these concepts, then you're in a place to make a better decision. You're not becoming a stock market investor after an hour, but what you will become is you will be able to connect the dots. You will be able to, now it's almost as if the mist has been lifted. And when you see things happening around you, you'll be able to connect the dots and say, this is why this is happening. And maybe look at your portfolio and say, am I too risky? Or why is my stock portfolio getting created? So that's the goal. How does everybody feel about that? Thumbs up, down, down. Hey, Donna, it's good to see you. And Brandy, good to see you. Great. So just a caveat, I'm not a financial advisor. None of this is financial advice. We're going to record this. I'm going to put it on my YouTube channel. None of your names are going to show. And what I will do is I'll put the speaker view. So your gallery view is not going to be showing. But if you're uncomfortable, then you can turn off your camera. But I'd love to be able to engage with you. But at least on the public profile, your name's not going to be there. And unless you're speaking, you shouldn't be there because I'll use a speaker view. But so I'm not a financial advisor. Great. So who am I? I'm a kid who grew up in Mumbai, and I didn't grow up with a lot of wealth. I left home for high school in Singapore and then came here for college. And I worked 5 jobs at college here to be able to stay in school. So I was a kid on Friday night, Saturday night, everybody was having fun. I was a kid behind the movies, showing the movies to everyone else. But I needed those 5 jobs because I needed to break out of a cycle and I needed to create a future for myself. I didn't go to an Ivy League school for my undergrad. And I found my way to Wall Street and one of the few kids who were from Ivy League, and I ended up at Goldman Sachs. And that was the start of a 20+ year career on Wall Street. Eventually went to Harvard Business School. And the reason I tell you the story is because investing changed my life. And I wish someone like me, I knew like 5% of what I know now back then for the first 5, 7, 10 years. And it was trial and error. It was learning from the best on Wall Street around me. It was like learning from them, seeing what they do, right? Learning from the best professor at Harvard Business School. I wish I had all this knowledge that I do now when I was starting to invest. I would have done so much better. I would have avoided so many mistakes. I would have had a strategy in place. None of these are gimmicks. And because investing changed my life, because I went from the kid who had to work 5 jobs at college to stay in school, to now being in a place where I have choices, it's because of investing. And that empowerment that comes from zero empowerment, which is what I had, 0, to having meaningful empowerment. How can I do that for a friend? How can I do that for a peer? How can I connect the dots with someone else who may not want to go through 23 years of Wall Street and trial and errors? How can I condense that 22 years into 10 weeks, which is my course? And how can I help someone feel massive empowerment that investing can change their lives over the long term, and that it is not complicated. In fact, it can be fun. It is manageable. It doesn't have to be complicated. And most importantly, it can be very empowering. Whether you do it yourself or whether you have a financial advisor, you're a better partner with the financial. So that's the goal. And that's why I want to do this. And that's why I left my Wall Street career to now empower women and men like you to live your full life. So that's the background. So let's get into this. Yeah. All right. Hey, Sonia, so great to see you. Alvin, great to see you. All right, so I'm going to share my screen and let's pray this gallery that I'm seeing in front of me does not disappear because there have been some tech glitches. Oh, it disappeared. Hang on 1 second. I have this beautiful gallery and every now and then it disappears. So give me 1 second, which means I will not be able to see right at you. And give me a second if I can fix it. Otherwise, I'll be looking sideways. I do have a backup plan. Okay. So I'll be looking sideways at you when I go this way. Know that I have a big screen on this side because there's a tech glitch and I cannot see you right in front of me. So, inflation. Who here wants to share how high inflation is? Just unmute yourselves and share. How high is inflation right now? Who would like to go? Just unmute
8.6.
8.6%.
Will you lie down?
And just to give you context, that is a 40-year high. A 40-year high. So if people can go and mute this, someone speak with background noise, please. So this chart here is the inflation in the US. It starts from the 1950s and goes all the way to the current time. The gray areas are the recessions that we've had. The most recent recession was 2020. The thinner the line, that means it lasted a shorter time. The thicker the line, that means a greater period of recession. This is the 2000 dot-com bust. This is the global financial crisis. As you can see, the last time we had inflation this high was in the 1980s, so a very long time ago. And it is pretty hard, right? Inflation is how much you pay every year, how much more you pay every year. The thing is, who here believes cash in the bank is safe? Just show of hands. Again, we're within a community, so cash in the bank is safe. Yep. Okay, I see a few hands. Yeah. The reason cash in the bank is not safe. Now, I put $10,000 into my bank account last year and I opened my bank account, it'll be $10,000, right? There's minimal interest that I'm earning. Next year, it'll be $10,000. 5 years from now, it'll be about $10,000. 10 years from now, it'll be about $10,000. It feels safe. But the problem is, between last year and now, here's my friend, the invisible Cookie Monster, right? Inflation. Inflation is the invisible cookie monster. Chomped away at my cash and I can't even see it. But because inflation is about 8.5%, that means 8.5% of $10,000, $850, Cookie Monster ate that away because I can buy less with that cash in the bank. And the higher the inflation is, the less my buying power, right? And that is the problem with cash in the bank, is over a long period of time, we don't expect inflation to remain at 8.5%. Let's not scare anyone. The goal is to get it down to 2.5%, 3%. That's what the Fed is in charge to do, and we'll go into that. But even at 2.5%, some of you have been in my Fund Natasha and Prince workshop, you can see how cash in the bank can really, it's guaranteeing you a loss. All right, so now that we know inflation, I want to draw a distinction between a sexy stock and a boring stock. Any ideas here? What's a sexy stock? Just unmute and share. What's a sexy stock? And put in the chat as well. So when I'm looking sideways, I'm looking at your view because of my tech glitch. So what's a sexy stock? Who here would like to go? Sorry?
Tesla.
Tesla is a sexy stock. Yeah, high growth, high risk. What else is a sexy stock? Netflix, Microsoft, Peloton, Crocs. Who here wears Crocs? Gosh, my kids love Crocs, right? That ugly shoe company. Crocs been a rocket ship, right? Crocs. So these are all sexy, very high growth stocks. That means they're growing profits like 15, 20, 25% every year. So they're growing pretty fast. What's a boring company stock? Who here wants to talk about a boring company stock? Coca-Cola.
Coca-Cola.
Coca-Cola, exactly. Classic boring company stock. Very mature, slow growth, slow and steady growth, like only 100 long, it's like kind of boring, That's Coca-Cola. Procter and Gamble.
Yeah. Netflix, Johnson and Johnson, those kinds of deals.
Johnson and Johnson, exactly right, Rocky. Colgate Palmolive, the toothpaste company. These are like mature companies that usually also pay a high dividend, if you notice, right? They're paying high dividends. They're very mature, the slower growth. So those are boring company stocks. Let's see how these companies have done. NVIDIA, it's one of the biggest semiconductor companies, biggest chip company. Who here has heard of NVIDIA? Yeah. It's a safe company. These are not rinky-dink companies. And that's what I want to highlight to you. These are not rinky-dink companies. These are very well-established, big, massive market share companies. NVIDIA has lost 47%. Now, just to give you an idea, think of a pie, a circle, and chop off half of it. It's lost that much value in just this year, the last 5 months. A whole circle, chop off half of it. It's pretty stark for not a rinky-dink company. Tesla, pretty much the same story, has lost 40%. Crocs, the ugly shoe company, has lost about 53%. Boring company, Procter & Gamble, is down. It's not a hero, it's down. It's down 19%. Colgate Palmolive, it's down 13%. I didn't show you Netflix chart. Anyone here knows how much is Netflix down as of right now?
60%.
Close, 70%. So think of a circle and take off 3/4 of it. A company like Netflix, let's just do a poll. Who here subscribes to Netflix? Yeah, almost all of us. If you think a company's safe, again, with single stocks, very risky. Coca-Cola, I forgot to change this 8% number. It's actually, that was on June 7th, a little bit before June 7th. In just a week and a half, again, it's gone down a lot, but this is flat. It's about zero, right? Zero. Netflix is down 70%, Coca-Cola 0. Netflix is down 70% more than Coca-Cola. Netflix is a very good brand, very good company. So why is this happening? Now, before I get into that, we talked about single stocks. So they're down a lot. I want to show you this. This is a little noisy. Let me explain it to you. The light blue line is QQQ. It's a fund. Who here knows what a fund is? Some of you, yeah. A fund, instead of investing in a single stock, a fund has got like hundreds of stocks. So QQQ has got 100 of the largest companies on NASDAQ. They're mostly tech companies, about 52% tech companies. So Apple, Microsoft, Tesla, Google. Tesla was down about 40%. Netflix was down about 70%, but look at this fund. It's down 30%. That's not good, but it's down a lot less. And that's one of the first concepts of diversification versus single stock investing, right? This isn't pretty, but it's a lot better than having lost 70%. Talk about Peloton, you've lost even more. Okay, so this is QQQ. Mostly tech, mostly sexy high growth. Look at the dark blue line. This is the dark blue line. This is the S&P 500. Who here has heard of the S&P 500? What's the S&P 500? Couple of you. S&P 500 are the 500 biggest stocks, biggest companies in the United States. Boeing, Procter & Gamble, a lot of these tech stocks as well, 3M. So these are 500 of the biggest stocks, combination of boring companies and sexy companies. It's down 23%, less than 30%, right? It's down less. And look at the purple line. It's down about 14%. This is, Rocky, you pointed out Johnson & Johnson, McDonald's, Sherwin-Williams, a paint company. So these are like super boring companies that are very mature, that are paying a high dividend. You look at all this and like, okay, two observations, right? Anyone wants to shout out some observations between the slides that I just showed between single stocks and this? What's going on? What are some of the observations here?
The bigger the portfolio, the less volatility.
That's a great observation, the bigger the portfolio. And I think what you mean to say is the more number of companies that you have, there's a natural diversification effect that happens. It reduces your risk. So that's a great observation. Any others? That was a pretty good one. So the point is, quite often, like when I did a show of hands, almost no one had heard of funds. That's because we're always bombarded with news about single stocks. Boeing, Apple, Tesla, Twitter, Elon Musk is going to buy Twitter, all that stuff, right? No one ever talks about QQQ, SPY, NOBL. It's kind of boring. But that's one of the key takeaways I wanted to leave you with is instead of single stocks are very dangerous to be basically mostly invested in single stocks for a non-professional investor. You're better off learning how to invest in funds that can also be very powerful in helping you get towards long-term wealth potentially. All right. So now that we've got that and we've seen how the sexy high-risk stocks have gotten clobbered and other stocks have gone down, Coca-Cola not as much, 0, but they've gone down a lot less. So the obvious question is what moves stock prices? Anyone wants to shout out and say what moves stock prices? What causes stock prices to move?
I have a bit of a cheeky comment. Elon Musk's comments will move stock prices.
That is true, and that's why he's in a bit of a pickle with the SEC. Yes, you're right, Claudia. Thank you for that. What else, other than Mr. Elon Musk? What else moves stock prices?
Interest rates rising.
Interest rates rising, Sonia. That's fantastic. Yeah, so interest rates rising, and that's where we're going to get into the crux of this. Is what happens. But really, when you take a step back, what moves stock prices?
Investor sentiment.
Sorry?
What did you say?
Go ahead, Giselle.
I was saying investor sentiment, fear in the market.
Investor sentiment. Yes, investor sentiment fuels the market. Yes, that's one of the things. And I think that's what's happening today is massive chaos and panic. So behavioral dynamics. But even before that, what moves stock prices is a surprise, right? Is a positive surprise or a negative surprise. So what happened on Friday? So let's just break this down. Just the most recent history. Let's take yesterday as an event and Friday as an event. So what happened on Friday was we got an inflation print, 8.6%. The month before that it was 8.3, and the month before that it was 8.5%. So it was moving in the right direction. Inflation was coming down. The market was expecting, again, the market was expecting inflation to be 8.3. Inflation came at 8.6. That surprised the market. And we'll connect the dots as to why the stock prices moved down, but let's just observe right now. Inflation print came, it was higher than expected, the market tanked. In the next 2 days, the market went down 10%. We'll get into why. Yesterday, Federal Reserve Chairman Powell came on and he talked about his policies around this. The market went up. And if some of you have seen, I made a post, don't believe this market rally yesterday. it's a fake rally. Again, I'm not running victory laps. I also said, beware of know-it-alls. Anyone who professes to know what they're talking about, run away from them. I worked in Wall Street long enough. I got lucky, right? I had a view, it was worth 2 cents. And of course, it was a fake rally yesterday and the market is down about 4% right now. So why? So the first thing I want to leave you with is when there's news that's different from expectation, positive or negative, that's what moves stock price. And that's what's been happening all of this past month and the last 6 months. So that's what this is. If there's news different from expectation. All right. So let's see what the expectation is for inflation. This is a 5-year inflation rate, and I'll send you some links so you can look this up yourself. But right now, inflation is at 8.5%, 8.6%. But that's not what the market is pricing in. The market expects that the inflation will go to 3%. As you see, a few weeks ago, the market expectation was much higher at about 3.5. So right now, the market thinks it will go down to 3%. The long-term target is about 2 to 2.5%. So we're not getting there. The market thinks it's 3%. In 10 years, the market is thinking we'll be close to 2.7. And this is, again, history at roughly 2. So we're pretty elevated right now. So this is what the market is pricing in. The market is not pricing in continued 8% inflation. Okay, so here comes the Fed. Not the FBI. It's not a sexy story. We don't live in the world of Hollywood either. Who here knows what the Fed is and what does the Fed do? Anyone wants to wager a guess? What does the Fed do? I'm trying to get my gallery screen up. It's so annoying that I can't see you guys right in front. Anyone wants to guess what the Fed is? No.
It's the Federal Reserve, chaired by Colin Powell, who his committee reviews everything that's going on in the country and chooses which way to go with interest rates.
Absolutely. Who was speaking?
Catherine.
Catherine, that's so great because while you were speaking, I also got my gallery screen up. So now I can look straight up at you and I don't have to like referring sideways. That was great. So you're such good luck. Yes, you're spot on. So the Fed is a non-political body and it's the central bank of the United States, right? And one of the key jobs is managing inflation. And the person who's heading up the Federal Reserve is Chairman Powell. Chairman Powell, it's like an intergalactic name, like something you've seen out of Star Wars, Chairman Powell. So anyway, Chairman Powell. It was great to see the news conference yesterday because everybody kept calling him Chair Powell, Chair Powell, Chair Powell. It's kind of cool. So one of the jobs is managing inflation. And the way the Fed manages inflation is by increasing interest rates. So why would that manage inflation? How does that, anyone wants to share? Like, okay, if the central bank of the United States is going to increase interest rates, how's that going to cool down? How's that going to bring down inflation?
Going to increase the cost of borrowing money, which is going to slow the amount of money that people are spending and putting into the economy. And hopefully it is going to reduce the high demand for certain things while supply chain and other issues kind of stabilize once again.
Sure, I think that was a terrific response, right? So for everyone, let me break that down. Let me unpack that. When the Federal Reserve increases interest rates, I think all of you have experienced this. Credit card rates go up. Home mortgages rates go up. Home mortgage rates are crazy right now, right? They used to be 2.5% about a year and a half ago. They're now like about 5%, right? Companies, if they want to buy machinery and they want to borrow a loan from a bank, that cost has gone up. So what will happen if if Coca-Cola wants to buy more machines and the cost has gone up, they'll probably reduce their spending, right? And Coca-Cola is a bad example, it's pretty resilient, but some of the company like Crocs, right? They will reduce the spending. They can't afford to borrow as much. So that's one of the things that happens is companies slow down, but also you and me. Look at our purchasing behaviors. I can't go on a vacation right now because airline prices are through the roof. Who here has started to book an airline flight? Through the roof. Who here has started to book a hotel room? through the roof. So I told my family, we're just going to be within half an hour driving radius. So that's going to be our summer plans, right? But it's pinching all of us. So what's going to happen is our consumption is going to reduce, and that's the goal. It's not happening yet. And that's the problem. The Fed has increased interest rates. Until yesterday, it was up from 0 to 0.8%. And on Friday, we got the inflation print. It's not working. Inflation is still going up. It's not working. So the market lost confidence in the Fed and was like, oh my God, the Fed will have to increase interest rates even more. Are you all with me? So increase in interest rates reduces the demand in both the business economy as well as your and my spending. And you and I are 70% of the US economy. Consumer spending is 70% of the US economy. So Fed takes a very close look at how you and I are spending money. And the expectation is that our demand will come down and that will lower inflation. That's the goal. That's one of the tools that they have. So let's look at it a little bit. So I'll explain this chart. It's a little scary chart. Let me explain it to you. Again, at the bottom, it just goes through years. So 1955 is the starting frame, just so that we get a long history. And then the blue line is the inflation. This is what you just saw, right? A little bit before. So the blue line is inflation. And as you see, it's pretty high, right? This is what we saw. So the green line is the federal funds rate. So when I was talking about the Fed increases interest rates, there's a specific one that they increase. It's called the federal funds rate. Bunch of mumbo jumbo. What it really means is it's like a borrowing rate that banks, when banks have to move money around overnight, don't ask me why, it's too complicated, but they do. There's a overnight lending rate that they charge each other, right? And it's pretty influential. So that is what the Fed controls. And that then has an impact, which we'll walk through in a second. But you see there's a correlation between the green line, which is the federal funds rate, and the inflation. So when inflation is super high, right, as inflation is high, the federal funds rate kept going up. This is the 1980s. It went up as much as 20%. 20%, right? Now that's a scary time. I'm not saying that that's what we expect, but that's what happened. And then as you see, like, you know, it's a pretty good correlation. So the federal funds rate has been effective in managing inflation. The problem is, in managing this, what can happen? If you're slowing down the economy, what could be a collateral damage from that? Recession, right? People could lose jobs. And that's one of the things of increasing interest rates as unemployment levels go up. But guess what? Unemployment is at 3.6%, the lowest in 50 years. There's not enough people to fill job vacancies. And again, this is my view, this is my 2 cents view, is the Fed can afford to engineer a recession and have unemployment go up to 4.1. In fact, that's what they expect. They expect unemployment to be at 4.1% by the end of 2024. It can go up even more. Normal unemployment levels, I think, are 4.5% or so. That's like considered full employment, somewhere around there, right? So the Fed could engineer a recession, and it's not great. People will lose jobs. That is awful. From an economic perspective, that could happen. But again, the Fed's policy is they expect the labor markets to remain strong. They think the US economy is strong, and the US economy can withstand these increasing interest rates. And the Fed's goal right now, they predict that the federal funds rate will be at about 3.5% by the end of this year. They increased it by 0.75% yesterday. Sorry, I'm throwing so many numbers at you. Is that too many numbers? Is that okay? Everyone doing okay? Okay. Everyone's okay. So yesterday, the Fed increased the interest rate, the federal funds rate, by 0.75%. It hasn't done that since 1994. Some of us weren't even born in 1994. I was in high school. It's pretty scary. I was still that nerdy, geeky boy who couldn't really talk to girls. That was 1994. That's the last time. And up until Friday, the expectation was that the Fed would increase interest rates by 0.5%. Okay, so let's connect the dots. So up until Friday, the market was expecting 0.5%. What happened on Friday? Anyone remember what happened on Friday? Inflation. Inflation came up at 8.6%, much more than expected, 8.3%. So the market said, oh my God, the Fed has to increase interest rates even more. The expectation was they would increase 0.5%, even more. And I'm going to connect the last piece, why that impacts stock prices. So the market is expecting they'll have to increase even more, and the stock prices crashed. We'll go into that. So far I want to, so you understand inflation. You see that to manage inflation, the Federal Reserve has to increase interest rates. So you see how those two are connected now? And if we go into recession, what will the Fed have to do? Increase interest rates or decrease interest rates? Because if you go into recession, the Fed then has to get the economy back up again, right? So at that point, what will they have to do? Decrease interest rates. Decrease interest rates. And then presumably stocks should go up, but usually stocks react ahead of time. Okay. Everybody clear on this one? Is it still pretty fascinating? Or am I just the only one who gets fascinated by the stuff? All right, Rocky's giving me a thumbs up. All right, so I'm going to show you one more chart. And this is going to be the link between stock prices and all the stuff that I've been talking about. So this is the same chart as you just saw. Same chart as you just saw. It's just got one more brown line. And the brown line is something called the 10-year treasury rate. Who here knows what a 10-year treasury rate is? What does a 10-year treasury rate mean? Claudia, what is a 10-year treasury rate? I'm impressed you know what a 10-year treasury rate is.
The Treasury looks to also get cash and money. So they issue a Treasury bond that is as a duration of 10-year time. So you can lend the Treasury money, if you will, for 10 years, and they pay you a coupon or interest rate every half year for lending you the money.
Claudia, that's great. That's awesome. Obviously, you've been in banking before. So, so let me just unpack what Claudia said. So basically, a 10-year treasury note is a 10-year bond, right? It's like a loan. Think about it as a loan. Like when you take out a mortgage, you take out a loan, right? A bank lends it to you. In this case, it's the US government giving you a loan. You're the bank. Okay, so US government wants to print money, and they print money, and they say, all right, great. So somebody has to buy this treasury note. So it's basically, it's a 10-year loan, and it pays an interest, right? There's an interest on a loan. And the US government will never default. It will never go bankrupt, right? At least that's the current view. So it's considered a risk-free asset, risk-free asset. So the interest rate on that is the 10-year treasury rate. And I can see the 10-year treasury rate is sort of kind of also correlated with the Fed funds rate, right? You see that on this chart? Sort of, yeah? Okay. So why did I go into this whole big spiel? Is because the 10-year treasury yield basically sets the price of almost all the assets. What's the value of your house? What's the value of your business? What's the value of bonds? Mostly, I'm simplifying it. It could be 5-year, 15-year, but simplifying it. And then ultimately value of stocks. The 10-year treasury yield determines, it's a factor in calculating the price, and that's what we're going into. So far you with me? And the latest is right here. So the federal funds rate has jumped from 0.8 to 1.6% after yesterday's move. The 10-year treasury rate is about 3.5%. Anyone wants to guess where the 10-year treasury rate was on December 31st, just 5 months ago? It's 3.5% right now. It will give you an idea of how wrong the Fed got it. The the 10-year treasury rate was 1.5% on December 31st. It's more than doubled in 5 months. And what's happened to the stock market? The S&P 500 is down 23%, and tech is down 30%, and Netflix is down 70%. It's all related. It's all related. I'm going to break it down for you. So the 10-year treasury yield has gone from 1.5% on December 31st to 3.5%. Why has Netflix gone down 70% because of this? And a name like Procter & Gamble is down 15-ish. Coca-Cola is about 0. Why? Want to know? I guess that's why you're taking time. So just quickly, right now, this is as of June 7th. The market was expecting 2.8%. Just look at this. Even a week ago, the market was expecting that the federal funds rate will be 2.8% by the end of this year. It's now 3.5%, right? This is the massive impact, and that's why stocks have just crushed even in the last week. So why? Why is this happening? Why is this happening? We've talked about the 10-year Treasury yield. It's Mr. Powell. I'm a big fan of Chairman Powell. The big question right now is the market pricing in enough of a federal funds increase or not? So right now the market's pricing in 3.5% for federal funds rate by the end of this year, right? Again, federal funds rate is what Chairman Powell controls. That's what he increased by 0.75% yesterday. That's what is at 1.6% today. The market expects that will be at 3.5%. And then Powell said we expect it to be about 4%, or based on some survey, that it's going to be 4% by the end of next year. Is it going to be enough? It's not going to be enough. I think my 2 cents, I don't think it's going to be enough. That's my personal view. Again, I remember what I said about know-it-alls. Nobody knows where things are going. Anyone who professes to, run away from it. So it's my 2 cents that I think that's not enough, because inflation is at 8.6%. And guess what? A big component of inflation is food and energy. The Fed cannot control food and energy prices because of what's happening in Ukraine. The Fed can't control that, but it has to manage towards the headline inflation number. And right now, when we look at housing, Powell was asked yesterday, is it going to help housing prices? And he said, well, right now, housing is really hot. There's such less supply and there's so much demand. Same thing with the labor market. It's so tight. What does tight mean? Is there's so many more job vacancies and so few people, so it's causing massive wage inflation. It's great for workers, but this is all leading to high inflation, which isn't great for people in the long term, especially people who are living paycheck to paycheck. It is really hard. Why tech stocks getting slammed? All right. It's going to be soon time to open up your spreadsheets and work with me. So we're going to get into value of a company. So what is the value of a company? And we're going to look at it 2 different ways. I'm going to describe, and we're going to look at a spreadsheet. So the value of a company, right? Let's say a stock price of a company today is $41. How do you come up with it? How do you come up with $41? So I'll give you a little sneak peek of what I did at a hedge fund. Anyone know what a hedge fund is? Claudia does. Yes. Okay. So what I did at the hedge fund, it's one of the jobs in Wall Street, is institutions, like big institutions, could be anyone. I'm just going to pension plans, college endowments, high net worth families. They give us a lot of money, and then we go and invest that in stocks. We buy stocks like you and I would, right? But we're buying it on a professional basis. We're trading millions, hundreds of millions of dollars of stock, right? So we manage a fund and we buy stocks and we sell stocks. So that's what we do. That's what I did on Wall Street for the last 5-6 years before I started my own thing that I'm doing now. So how did I value a stock, right? This is what me and all my peers do on Wall Street, is you take the profits of a company, right? So for Apple, you know how many, you try and estimate how many iPhones are they going to sell, how many Mac computers are going to sell, how many iPads are going to sell, how many AirPods, what will it be able to do for pricing? So you try and forecast this pricing, what are the costs? So then you come up with a profit, right? You see how you get the revenue, you see how many am I going to sell of these, how much I'm going to price, what is my cost, and therefore what's my profit? How much am I going to put back into the business for more machines and shops and all that stuff? And then what is my cash profit? So I'm going to try and forecast that cash profit and then value the company based on cash profit. And I'm going to tell you how I value that. Okay. It's called discounting future cash flows. So we understand future cash flows. We all understand that cash flow is the profit, cash profit. Futures is in the future. And I'll explain what discounting means. But basically, bear with me for a second until I show you the spreadsheet. I'm going to use all these future cash flows and I'm going to reduce the value. Basically, if I expect a 10% return, because if I want to buy a stock of this, I expect a 10% annual return. I'll basically reduce the cash flows by 10% every year, come up with a value today and say that'll be $41. Okay, that's how I come with the present value of a company. That's the price of a company. I'm simplifying this, but this is basically giving you the idea. Now, the difference between a high growth and a boring company is this. All right. So the green is the high growth sexy company and orange is the boring company. All right. Again, what we mean by high boring company is moderate growth. So they both start off at $100 million in cash flow. So they both have $100 million. Okay. Now I'm going to start projecting. I'm just making stuff up. Now, people like me and others who do this on Wall Street are really good at what they do, right? So they're not just pulling stuff out of thin air. They're really good at what they do in forecasting. but it's not a crystal ball. So they try and forecast and they say, okay, this company is going to grow its profit by 20% every year. So the 100 million profit will become 120, which will become a little more than 140, which will become a little bit more 160. You see, so that's how the growth is. But the company is not giving these projections out. This is being made up by the Wall Street analysts. This is what I used to make up based on my best judgment. The company will kind of give you an idea of where they're going with their business. They will give out a projection for the next 1 year, not for the next 5 years. And then we usually generally build out another 5 years. Okay, so these are all based on judgment and assumptions. And then there's a big number that we put at the end because this company presumably will last for another 80, 90, 100 years. It depends on the company, but we can't keep modeling because it's garbage in, garbage out. So we make a big number at the end. There's science behind it. There's some judgment. There's a lot of art behind it, and I'll show you. But most of the stock price today is a factor of that big price that we put at the end. All right. Hold that thought for a second. Have I lost anyone yet? Okay, I've not lost anyone. So now let's go over to the boring company, and you see it's kind of like humming along, and like. I started at 100, talk about comparison, what a shitty thing to do. Now, if this company starts comparing itself to this company, it's not going to be in a happy place. Humming along, seeing this little company on the other side. Oh my God, humming along. We'll see who the hero is. All right, this company is growing at 5% every year. It's like a boring company, Clorox, Procter & Gamble, whatever, right? Mature company paying dividends, and then after 5 to 10 years again. Similar, an analyst will be modeling this out and will assume that it slows down and comes to a normalized rate. You see how these future cash flows are going to be worth a lot less than this? You can see that, right, generally? And I'm going to put a big number here as well at the end, based on the growth profile, because again, this company can presumably go on for another 100 years, Coca-Cola. I'm going to put a big number here as well. But this number will be a lot smaller than this number, right? Naturally speaking, because this is a much higher growth. So when things, hold up. Okay, so with that, let's go to the spreadsheet. Everyone should have received the spreadsheet. And if not, just ping me and I'll send it to you later. All right. So let me just break it down. Sorry, spreadsheet. We all get scared when we hear the word spreadsheet. So don't worry, I got you. There's only a few lines, and I'll break it down and I'll unpack it for you, and you'll become masters at using the spreadsheet, okay? Now, please don't use this spreadsheet to model Apple or Google or Crocs or Coca-Cola. This is a very simplified version. My model had like 1,000 lines in that, okay? So this has got like 5. So this is to illustrate the concept to you. Okay, so remember that green company with the green cash flows? Let's recognize numbers. That was visual. Now I'll show you numbers. 100 growing 120, 144. So the first line is cash flows. Up on top is the years. So I model year 1, year 2, all the way to year 10. So these are those cash flows that you saw in the green bars. This is my growth rate that you saw below the green bars. It's 20%. Then in year 7 goes to 10%. Why 10%, Andy? I made it up. Right? I made it up. The company didn't tell me 10%. The company can't tell me that. They don't know. I made it up based on my best judgment. And then after 10 years, because the company's still going to be around, right? Hopefully, I'm assuming it will grow for 5%. I just made that number up, right? It's going to grow at 5%, a little above inflation. Okay. So then what are the cash flows? This is 100, 120, 144. Hey, Andy, what is the $7.7 billion number you put in there? Remember I told you I put a big number at the end of 10 years? Because I can't model the company for 100 years. It's garbage in, garbage out. So again, there's some math behind this. Some very famous economists, financial gurus have come up with this formula, right? We're not going to dissect this formula or try and prove or disprove it, but there's a formula to try and estimate the value of a company. Because this is a very high growth company, this has got $7.7 billion in here. So then I bring it back down. Let me break it down. What do I mean by that? Andy, what do you mean by that? All right, there's a discount rate of 10%. I'm going to break it down. This is what you expect to earn for taking a risk in a stock. And in this 10% number, guess what number is in the 10% number?
Inflation.
In an indirect manner. What is
The Fed interest rate.
in an indirect manner?
Treasury yield.
10-year treasury yield. Woohoo! So Claudia led us to connecting the dots to Rocky. Rocky led us to the final answer. Wonderful. All right, in the 10% number, the 10-year treasury yield, which is now 3.5%. It was 1.5%. All right. So this number will change. If the 10-year treasury yield goes up 1%, this number could change to 10 to 11%. Again, I'm simplifying it, but this is for the idea. All right, so let's hold that thought for a second. All right. What does it mean that I need 10% rate of return? Let me break it down. Let me unpack that. Okay. So the current stock price of this company is $42, $41.95. We'll get to that. But you see this big number, $7.7 billion? This $7.7 billion, what I'm saying is by this rate of return, what I'm saying is like, look, I want to earn a 10% per year return if I buy this stock. That's what I demand. So basically I work backwards. And if I basically reduce the $7.7 billion by 10% every year, if I reduce this by 10%, this is 7 billion. If I reduce by 10%, it's 6.3 billion. Keep reducing. The value today is 3 billion. Everybody with me? If I'm buying the stock today and I'm estimating that in 10 years, this will be 7.7 billion, I expect a 10% return, okay? And if I break that down into share price, this company has basically got 100 million shares outstanding, 100 million shares. This is the total value of a company, total value. So I just divided by the number of shares, that gives me the stock price. So this is the stock price, okay? So this 7.7 billion of cash flow at the end that I've assumed is worth 29.50 today. And you see how this basically becomes 32.45, that's a 10% growth. Remember I said I want a 10% growth. If I buy this company today, I want a 10% return every year. So you see, if I buy this for 29.50, I'm getting a 10% year every year. And this $7.7 billion is 76.51. The math all works out. So 29.50 is the value of this cash flow. But there's this cash flow, this cash flow, this cash flow, this cash flow, all the way to this cash flow. There are all these extra cash flows. I do the same math for all of them. You with me? I do the same math with all of them, and voila, I get $42 in price. Everybody with me? And how much is this big number that I put in there? 29.50. It's most of this value here. You see that? Okay. So that's what I want to understand. So that concept. Okay, now let's bring it home. Let's bring it home. Let's stay on this sheet because this is much more fun to work with. If I increase my discount rate, say the treasury yield went up by 1%, I'm going to change the discount rate to 11%. You want to see the magic that happens? Look at this number. Eyes peeled hard at the 41.95. I'm just going to change this one number, 11%. For a moment there with the lag, my heart sank. Is the spreadsheet not working? Did you all see that half a second lag before it calculated? 34.27. Wait, what? Andy, what? 41.95 went to, you can see this right here. So 10% is 41.95, at 11% 34.27. This went down 18%. The price went down 18%. Do you see that? In dollar terms, it went down about $7, right? A little more than $7. You want to see where most of this came from? Look at this number. This is that big number at the end. It's worth 29.50. Tell me how much it goes down by. Okay, it's 29.50 right now. I increase it by 1%. How much did it go down by? About $7. Most of this share price decline came from the decline of this number today because it's such a big number. All right, let's compare to the boring company. Here's a boring company. It's like chugging along, 5% every year, 100, 144. Okay. This is its terminal value. It's called the terminal value. It's a lot lower, right? It's a slow growth company, so it's a lot lower. It's 1.8 billion. I do the same math. 10% rate of return. I do the same math. Again, I've made some simplifying assumptions here. I do the same math, and we say the price today is 14.45. The price today is 14.45. When you change this 10% to 11%, for this high growth company, the stock price fell by 18%. This fell by 11.7. Why? Anyone wants to articulate why? For a 1% increase in interest rate, why did this go down about 12%? This went down about 18%, which, by the way, is exactly what we've seen, right? We've seen the sexy growth stocks have gotten created a lot more than boring company. Anyone wants to articulate why? I'll help you along with it. It's because of this big number, right? It's because of this big number at the end called the terminal value. A high growth company, and you'll see this in the Wall Street Journal, other articles, high growth companies have a lot of their cash flows out in the future. You see that, right? A lot of the cash flows out in the future. These cash flows are worth a lot less today when interest rates go up versus a boring company stock. So that's what you saw. That's point number one. What is the other impact if interest rates go up, inflation is up? What do you think happens? What else can happen to a company, a high growth company? What else could happen? The growth can come down. It's a high growth company. It's on rocket ships. The growth can come down. You want to see the demand comes down. Yeah.
Right.
You want to see the impact? You want to see the impact? It's even greater. Let's look at the impact. So there's another spreadsheet here. I want to break it down. You can do all in the same spreadsheet. Okay, so this company is growing at 20% every year, right? We talked about it. Let's just whack the growth rate by 10% every year. So 10% of a 20% growth is about 18%, right? 10% of 20 is 2%. So we reduce the growth rate to 18%. You want to see the impact? What happens to 41.95? $35. I just reduced the growth rate by 10%. It went down to $35. And you can see this here. When you reduce the growth rate, this company's stock price went down by 16%. And the same thing, if I reduce the growth rate by 10%, this company's stock price went down by only 2.5%. Again, the difference between a boring company and a high-risk company.
Damn.
So now you see why a company like Netflix, let's add now both. I'm not saying this is Netflix cash flows, but let's illustrate. I reduce it by, so this is 41.95. Let's just put 41.95. Let's see the combined effect of this. 41.95, I reduce my growth rate to say 18%, and I increase my interest rate to 11%. The price is now 29.28. That is, how much did it go down by? It went down by 30% in this case. Netflix has gone down even more. I'm just going to make up some numbers. If the growth rate came down by 15, right? Maybe the growth rate came down quite a lot, right? So now you start seeing the greater impact of a high risk, high growth stock. But let me take a pause there and then connect the dots for you some more. So I'm going to change this back to what we had. So we saw this impact. So do you now see why? Do you now see why these scary charts that I showed you initially, NVIDIA, does not make sense why it's down almost 50%? And this is from January to date. Where was the 10-year treasury yield? In December 31st was 1.5%. Where is it now? 3.5%. Why? Because the expectation for inflation has gone up. And that means the Federal Reserve has to increase interest rates way more than the market was expecting. The market hadn't priced this in. And now that it's becoming apparent, this has gone down. What can cause it to go down even more? Right now, the expectation for the federal funds rate is 3.5% by the end of this year. It's currently 1.6. If we get scary inflation prints over the next few months, that means the Fed's work is not being translating into the economy. And interest rates may have to go up even more. So it could, I'm not saying it will, it could cause a further decline. However, we can't time the market. What will happen? Do you think there could be a snapback? At some point, there'll be a trough. Perhaps we could go into recession. But at some point, it's going to snap back, and guess which names will be up the most?
High growth.
High growth, high risk, because it's the same thing. You can play around in your spreadsheet. This is yours to keep, by the way. Look at what happens when growth goes up 10%. This went up 20%. If we are in a recession, that means the Fed will have to decrease interest rates. What happens when they decrease interest rates? From 10 to 9, the discount rate here went from 10 to 9. This went up 28%. So this can snap back up very quickly, which is why it's very difficult to time the market. Okay, so Annie, so how do I invest? How do I invest, right? Do I just stay in cash? Well, if you're a long-term investor, heck no. Again, this is not financial advice, but if you're a long-term investor and you're investing consistently every month, heck no, because you can't time the market. But my secret sauce of investing, which I'll give it to you, my students who are in my 10-week course learned this, and we're in week 3. We had a fascinating session just before this. Kath is in my session. Several of you here in a few of you are here in my course. I'll just give you the secret sauce, and this is my secret sauce. The funny thing is, it's not so secret amongst professionals, but it is a big secret with non-professional investors. You want to be invested in decent, not the best, diversified funds. A fund is something that holds hundreds of stocks or hundreds of bonds. So decent because there's no best, really. Decent, diversified funds that don't move together. And that don't move together part won a Nobel Prize. I didn't learn about it until I go to Harvard Business School. For the first 6-7 years of for 5 years on Wall Street, I didn't know about this concept of don't move together. I learned about it at Harvard Business School, and I'm like, oh my God, this is so powerful that when you combine assets that don't move together, like gold, US stocks, international stocks, bonds, you can actually reduce the risk in your portfolio. So let me illustrate that. This is a scary chart, and we got 2 more minutes. Can everybody stay on for a couple more minutes, and then we'll wrap it up, and I'll have a 10-minute after party. This is a scary chart of the lost decade. This starts in February 2000. This is a 40% crash during the dot-com bust. This is the global financial crisis. This looks pretty scary. If you'd stayed in cash, you would have made a 0% return. Forget inflation. Had you invested in the S&P 500 every month, you could have made a 37% return. Had you combined that with emerging markets fund in a 70-30 ratio, emerging markets are companies in China, India, Taiwan, 70-30 ratio invested every month, you would have increased your return to about 51%. This is no gimmicks. This is using the concept of bad dance partners. I call them bad dance partners. They don't move together. Had you added bonds and gold, which also don't move with these other asset classes, you could have had a 61% return. History is not a predictor of future performance. This is a way to show you how you could be in a very scary time like this, be asking yourself, oh my God, recession is coming, a market crash is coming to exchange cash. Well, look at this scary time frame. And again, if you're investing systematically in basically decent diversified funds that don't move together and customize that portfolio to your values, risk, and goals, you could potentially be building long-term wealth. And the way to do that, again, is think about your risk profile. Think about all these different asset classes. Most people just play in US equities, and that too in single stocks. And there's this whole world out there that is very accessible to you. You just need to learn how to do that. And once you've picked these big asset classes, you go through this framework to pick funds. And really, you need maybe 5 to 10 funds in your portfolio that don't move together, that are across asset classes, that then you monitor on a monthly basis. And that's the way to then invest through volatility, through these rough times. So look at me, the market's down a lot. I'm pretty chip today. Yeah, I'm not chip, but I'm pretty happy. But my portfolio is looking sad. But I can't live life with the ups and downs of how my portfolio is doing. I know that I've invested systematically using the concepts I've just taught you, and that I'm in it for the long term. And that's the way. So one of the big takeaways that I'd have for you is, I'll stop here, is now you know how inflation is related to what the Fed does with the federal funds rate, which then translates roughly into the 10-year treasury yield, and how that impacts asset prices. And then there's the high growth stocks, and then borrowing company stocks. And you may want to take a look at your portfolio and see, are you basically in single stocks versus funds? Second is, are you primarily in one type of single stocks, like maybe just tech? And then you understood why your portfolio may be worse than the market because of that. Now you understand that. Now you can make some decisions. All right, what do I do about it? Do I want to go into funds? Do I want to have a mix of different kinds of companies? Do I want to have different asset classes, international equities, bonds? There's a variety of different kinds of bonds you can be in. You can set up something called a bond ladder. We can all talk about this later. I'm throwing a bunch of jargon, but what I want to expose you to is there's opportunities out there that you as a non-professional investor can absolutely learn how to do it. It's not scary, actually. It's fun, it's exciting. And like I said, when I started off, it is massively empowering. So with that, I'm going to finish off here. I would love to stay on for another 10, 15 minutes for an after party and answer any questions. You can always send me an email. You've got my email address. I look at every email. I'll respond to it. My mission in life in this chapter of my career is to empower you, because that changed my life. No one taught me. I had to take 22 years. And I want to teach you how to do this in 10 weeks, which is my course, or through free workshops like this, where I can teach you one concept at a time. So thank you very much. Thanks for spending your valuable time with me, and I'll stay on and take any and all questions you've got. So thank you, thank you, thank you. So great to see you. So great. Gosh, all of you.